Welcome back. In this video, I'm going to be explaining a very simple concept that many people are finding difficult to understand, which is the institutional order flow. I'm going to break it down to the smallest bit to help you understand this concept once and for all. And I promise you, if you understand this, it will change the way you read price. This year, what I'm going to be explaining is a simplified summary of how to use the ICT institutional level, that is the ICT order block, breaker block, fair value gap. All right. Institutional order flow. What is the institutional order flow? If institutional order flow is bullish, institutional levels, what are institutional levels? These are the order block, breaker block, fair value gaps. All right. Below the current price are expected to act as support during price retracement until price delivers to its objective, which is usually external liquidity or an inefficiency that needs rebalancing. All right, let me show you guys on chart. You can see an example here. So now, if institutional order flow is bullish, that this price wants to go higher, running forward liquidity, every institutional level will support price from going lower as price rallies higher to that level of liquidity. Now, looking at price rallied from this point to this point. So here is what we call the origin, and then here is what we call the terminus. So the institutional order flow only applies until the target or terminus has been achieved. Now you can see what happened here. Price created what? A down close candle, which is an ICT bullish order block, and was confirmed by this candle here. This candle closed above the open price. Okay, and then it left what area of inefficiencies here. You can see we have fair value gaps here. This range which was created, you can see it created range low, range high. Now, if price should retrace, where do you think price will find support? At this area of institutional levels, either this order block, fair value gap, and then you can see we have what a breaker block here. Why is the breaker block? This run here took liquidity. Okay. After taking liquidity, it broke structure. Right. So this is the last up close candle before price took liquidity. If price should return, most likely price should find support here. So this is what we call a breaker block. Okay, we have a lot of institutional levels here. This institutional level should hold price. So whenever price is retracing, when the institutional order flow is bullish, we're looking forward to see price find support at the nearest institutional level. All right. After doing that, price what rallied. It created what another down close candles. We have consecutively down close candles here. So we have the ICT bullish order block. Price rallied higher, retraced, found support, rallied again, came back down to that same order block, found support. And if you look closely, you see that we have another order block here. Price found support, then rallied. Although you can see another retracement here, you can see how price found support here and then rally, taking what this buy side liquidity. Now, as soon as this objective was met, you can see how price began falling lower. This order block was not respected. This other block was not respected. This was not respected. Price kept tanking. Why? Because institutional order flow has achieved its objective. So therefore, if institutional order flow is bullish, we want to see every institutional level holding price until the objective is achieved. Meaning that if you can predict where price is most likely to go, you can trust every institutional level as price retraces. You can be buying here, buying here, buying here, and buying here. Now, once this objective is achieved, you'll stop buying. Another way to apply this concept is when you see clear liquidity above price here, you can see here, you can see this buy side liquidity, and price keep finding support as it rallies higher on each institutional level. This will reveal to you that institutional order flow is bullish, giving you the opportunity to participate on the bullish move. So let's take an example of the bearish institutional order flow. So here's the reverse. If institutional order flow is bearish, institutional levels above current price are expected to act as resistance during retracement until price delivers into the bearish objective. All right. So you can see what happened here. Price moved from this level to this level. Here's the target. And as it kept tanking lower, it left what institutional levels. And as price retraced back into the range, it found resistance at each bearish institutional levels. So you can see here is an order block, ICT bearish order block. It was confirmed by this candle. This candle closed below the open price. As soon as price retraced, you can see how it found resistance, filling this area of inefficiency. Price fell. And then as price retraced again, you'll notice that we have what a fair value gap, area of inefficiency. And we have what we call volume imbalance here. You can see how price retraced back into it, fell. Now, as it was retracing, it left what? A bearish ICT order block. You can see it returned here, 1, 2, and fell. The moment it took what? The sell side liquidity, you can see how price consolidated and then began going the other direction. So the key thing here is knowing where price is most likely to go. You want to maximize the institutional levels price leaves as it moves. These are the kinds of trades you want to be in. You don't want to be in a market that is neither going higher or going lower, that is consolidating. You want to be in a trendy market. Let's take, for instance, price is currently at this level, that's filled this area of inefficiency, and you're able to predict that price will run for this low because you can see we have a market shift after price took what? Buy side liquidity. You can see price retracing into what? Premium. All right, this is a daily time frame. So what you can do is to go down to a smaller time frame and then look for every bearish order block, every bearish fair value gap, every bearish breaker block. As price retraces back into it, you want to be using it for a sell trade to run for this low. As simple as that. So the law states that if institutional order flow is bearish, the institutional levels should hold price. If it does not hold price, then institutional order flow is not bearish. Probably the institutional order flow has changed from bearish to bullish. So let's go to the chart so we can look at proper examples and how we can use it for our trades. All right, guys. So here's the USD card, a perfect example. Now you could see that price was running for this high, although it hasn't gotten there yet. I believe it will get there soon. The market just opened this Sunday. Now you can see we have an area of inefficiency at which price found support before rallying here. This is the 4-hour time frame. And you can see how price rallied, came back down, found support in this fair value gap, rallied again, came back down, found support, and then we are seeing price rallying higher. So I expect price to take what? This relatively equal high. So now what we can do is to go down to a smaller time frame. If you go down to 5-minute time frame, let's look at the order flow. So here is the 4-hour fair value gap, like we stated in the 4-hour time frame. Now, when you want to start using the institutional levels, you want to wait for a market shift. Now, remember, we already predicted that price is going to run higher from this level. Okay. Now, whatever time frame you're working with, you want to use the areas of liquidity you can find on that very time frame. So now, if you look at this is the 5-minute time frame. What's the most likely draw on liquidity here? This high, 1, and then this high. These are both clear draw on liquidity, and you can see how price took it here. Now, from this point here, point A to point B, you can see institutional order flow at work. As soon as the objective was achieved, you can see how price retraced back down again. Now, let's take a look at it. Remember, before you start using the institutional levels, you are waiting for what? A market shift, a clear market shift. This is to take away all the noise. And you can see a market shift here. You can see price created this swing high, this swing low, and then got broken by this candle. And not only that, this is what we call a change in state of delivery. I think I should make this tick. These consecutively down close candles. This is the open price. As soon as price closed above it here, we have what? A change in state of delivery. These down close candles are also what we call the ICT order block. And you can see how price came back down to find support here. On doing that, it left what? Another bullish order block here. So price rallied, came back down, found support. You can see we have an area of inefficiency. Okay. Another thing we can see is bullish breaker block. All right. Why is it a breaker block? It's the last up close candle before price took what? Sell side liquidity. As soon as price swept liquidity, it broke structure. So coming back, we expect price to find support here. Okay. Now, as price was finding support, it left what? Another bullish order block here. You can see how price rallied higher, took out this high, came back down, found support here, and then rallied again. And then took out this buy side liquidity. You have to be careful now. Whenever liquidity is taken, external range liquidity is taken, price usually retraces back down into a higher time frame support level. But you can see price didn't do that here. It retraced down into what? This order block, filling this area of inefficiency. It did not take this low. It rallied, took out this buy side liquidity, and then fell. It did not respect this consecutively down close candles here. All right. Took out this low, and then kept coming down. Now, why did price retrace like this? Because there's a higher time frame institutional level. If you go to a 15-minute time frame or a 1 hour, let's go to the 1 hour time frame. Okay, so if you go to a 1 hour time frame, you see that we have what? Liquidity here. So price came to grab liquidity before running higher. So this move here is a bullish institutional level. Where do you think price is running for? Either area of inefficiency or liquidity. So you can see we have an area of inefficiency here, even down to this order block here, this bearish order block before price came back down again. So let's look at the 5-minute time frame to see how price used institutional levels to rally higher. Remember, I said before you want to start using the institutional levels, you want to see a market shift. This just takes out all the noise. So where do we have a market shift? We have it here. It created what? Consecutively down close candles. All right. This swing high, price broke it. So we have what? A market shift as price breaks this swing high. Now, if you draw the order block here, we also have a fair value gap. You can see how price returned and then rallied higher. And in doing so, it also left another bullish order block here again with an area of inefficiency. Okay. The second thing we want to notice, this is a breaker block, this consecutively up close candle. Why is it a breaker block? It's a last up close candle before price took what? Sell side liquidity. The moment price breaks this high, because we have a break of structure, if price should return, we're anticipating that price should find support before rallying higher. So you can see price finding support here again. We also have consecutively down close candles here. As soon as price closed above it, let me just expand. Price closed above here. It is the open price. Price returned, found support, and then boom, it rallied. We have another order block here again. Although we have a fair value gap, but price did not return to it. But using this order block, price found support here with this area of inefficiency, rallied. And you can see the objective was achieved. And another thing you want to notice, this is already outside the trading Q zones. All right. This is like over to the next day. That's why we are seeing all this consolidation. Now we can see another retracement again because this institutional order flow has achieved its aim. Now, price is retracing back down into a higher time frame institutional level to continue another institutional order flow, which is still bullish. Okay, so it is based on the time frame. If institutional order flow is bullish in the 1 hour time frame, every retracement, price will find support at the institutional level. But if the institutional level fails to hold price is most likely running to a higher time frame institutional level before continuing another leg or another bullish order flow. But if the institutional order flow in the higher time frame has been achieved, then we would see that the higher time frame institutional level will fail to hold price, and we get all this information from reading the context and price action. All you just need to know is where is price most likely to get to. Once you can achieve that, you want to utilize every institutional level being formed as price moves to that direction. If price should retrace to that level, you want to be using it for a trade opportunity. So here's the last example. You can see this retracement. So if we go down to a 1 hour time frame, where do you think price retraced to? We can see a fair value gap here. Let me just draw it out. And you can see how price neatly closed inside the fair value gap. It did not close outside. This is showing strength. Secondly, if you draw your fib from this low to this high, you see that price is below equilibrium. Price at discount. You want to buy at discount, sell at premium. So going down to the 5-minute time frame, you see that we have what? A market shift here. Market shifted. Now this is the NFP, and that's why you can see volatile candles. Price retraced down into a fair value gap, and then boom. Okay, and this is where we are currently. This is our drawn liquidity. I'm anticipating that if price opens fully, that is London and New York session, we should see another bullish institutional level to run for this high. All right, I hope this was helpful. Please, if you enjoyed this video, give it a thumbs up. And if you haven't subscribed to this channel, please do and show me some support. All right, see you guys next week.